panel, we're going to talk about alternative strategies for raising capital. And really, what we're doing here is we know there's OTC, we know there's the public markets, we know there's the private placement space. We're going to try and make a little bit of sense as to exactly how it works, where does everything fit in. If I'm a company looking to raise capital, what's my first call? Where do I naturally fit in the capital raising spectrum? Should I still consider the traditional forms of raising capital? Should I look at Reg A? Should I look at Title II? What does that even mean? So we're going to explore that. We have a very good set of panelists here. My name is Brian Korn. I'm a partner at the law firm Manatt, Phelps. Just a quick word, we are a full-service law firm specializing in financial services, healthcare, and entertainment. I specialize in crowd finance, securities regulation, SEC compliance, also investment advisor and broker-dealer compliance. I also run our marketplace lending group, which helps platforms and investors raise money online, lend money, everything from borrower compliance through distribution.
My name is Scott Jordan. I'm an investment banker with Healthios Capital Markets in Chicago, Illinois. I'm also a fintech executive. Launched HealthiosXchange, which is an online investment marketplace dedicated to connecting investors with emerging growth healthcare companies.
I'm Scott Andersen. I'm a securities attorney. I have a law firm at finlawyer.com. I'm also general counsel for a fintech startup called FundAmerica, which I hope to talk a little bit about today.
I'm Ryan Feit. I'm the CEO and co-founder of SeedInvest. SeedInvest is a leading equity crowdfunding platform based down the street in New York. We have about 17,000 accredited investors and just over 100,000 total investors. We've funded about 60 companies to date through 506B and C, which I can talk more about. And we've been pursuing Regulation A+ as well. So I'm sure we'll get to that as well.
And I'm Chris Tyrrell. I'm the CEO of OfferBoard and our broker-dealer OfferBoard Securities, which is a FINRA member. And we do online private placements in the crowdfunding space and the institutional space. I'm also the chair of CIFRA, which is the regulatory advocacy organization for platforms operating under the Jobs Act.
I'm Mark Elenowitz. I'm the CEO of ChartPoint Global Equities. We're an institutional investment bank here in New York. We primarily focus on capital raises in the public markets, secondaries, follow-ons, and for the last 3 years we've been building an online digital platform called BANQ. It's a full-service online digital platform that takes the entire process of underwritings, private placements, all digital, and not only effectuates the beginning of the transaction, but the secondary trading and the aftermarket support of those transactions.
Excellent. So, for those of you who don't know, the Jobs Act is the Jumpstart Our Business Startups Act. We actually just celebrated the 4th anniversary of the Jobs Act on April 5th. It was an act of Congress that was largely bipartisan supported. Over 400 votes in the House, over 95 votes in the Senate. Really, other than naming a post office after someone, you don't see a lot of legislation that has that kind of a widespread support mechanic. A lot of what the Jobs Act did enabled, went into effect right away, such as the IPO on-ramp, what we call Title I, and other parts of the Jobs Act required SEC rulemaking, and that rulemaking has stretched for over 4 years. Finally, in May, we're going to have the last piece of the Jobs Act puzzle filled in. But Scott Andersen, and we have 2 Scotts, so I have to be specific. Sort of talk us through what was life like before the Jobs Act, and how has the Jobs Act changed the legal landscape in terms of what's available for potential offerings?
Yeah, it used to be that a private offering was private. You had to have a pre-existing substantive relation in order to, do a private placement transaction with somebody, and that all changed. And now the lines between what is a private and public market has been blurred, largely by the Jobs Act. One of the revolutions of the Jobs Act was Title II, which brought with it general solicitation, which means while you're doing a private placement offering, you could solicit, which means advertise generally in any way that you could imagine, on TV, on radio, in newspapers, etc. And you're soliciting something that is the sale of a private placement security.
And Chris, I know you were involved in the Jobs Act enactment itself. What was sort of the impetus behind the Jobs Act, and sort of where do you see the cards?
The real impetus was frustrated entrepreneurs. I mean, there's a lot of folktale about the origins of the Jobs Act, but one of the versions is that Sherwood Nice, Jason Bex, and Zach Cassidorian were all alumni of the same university, and they were at a wedding of one of their fellow alumnus, and they were frustrated. Two of them had run Inc. 500 companies, which are the top 500 growing companies in America, and they were trying to raise a round of capital for a new company, and they're having trouble. And one of them said to the other, "Why can't we do this online?" And, one of the other ones said, "Well, it's illegal." "Well, why is it illegal?" "Well, there's this old securities law." "Well, why don't we," not knowing what they didn't know, it was like, well, let's go take pitchforks to Washington and get that changed. And so early on, it literally was 50 people standing on a postage stamp-sized piece of grass on the lawn between Union Station and Capitol Hill, and the right staffer happened to walk by and say, what are you guys doing here?" "Well, we're trying to change the securities laws." "Well, you could do that better at my boss's office," and invited them in, and several congressmen and senators got together and wrote a very bipartisan bill. I think the way Congressman McHenry put it was, unless you're naming something no one's ever heard of after someone else no one ever heard of, you never get that many votes. And we got the Jobs Act.
So, so we walked through the Jobs Act. Title I, we talked about the
Title I
IPO
was the
on-ramp.
IPO on-ramp. Title II was general solicitation, which we just talked about. Title III is actually called crowdfunding, and it's creating a new kind of securities, crowdfunded securities, which are freely tradable immediately to institutions and 12 months later to individuals, which are only issuable up to $1 million per year, and which can only be sold to individuals with limits. Individuals can buy $200,000 to $100,000 worth of crowdfunded securities every year based on their their assets and their net income.
Okay. And then Title IV, you want to explain a little bit about what Reg A is?
Sure. Title IV is called Regulation A+. It's a new kind of public offering. It's up to $50 million or up to $20 million, depending on whether you use Type 1 or Type 2. And those, you get different things. One, you get state preemption, and the other, you get some other sweeteners in it. But it's two different kinds of offerings, but up to $50 million in public securities, but with a lighter regulatory burden.
Okay. So one of the things that's interesting about Reg A is that before you didn't have state preemption, so you had to go to each state and ask for permission to list the securities, which is an extremely cumbersome process. States get very suspicious of these activities. Some of them will say no. And so the natural course was to do Regulation D, which is Title II, unlimited amount of money to an unlimited number of accredited investors. Now we have Regulation A, which allows you to go to both non-accredited and accredited investors, and the SEC estimates 92% of Americans live in households that are not accredited. So there's a huge group of population, and some of us who live in New York tend to be a little bit jaded about what accredited investor, but it is a substantial amount of money that you could make and still not be accredited across the entire country. So, and these are people who work very hard, obviously, and deserve to save for retirement just like the creds. So why not open that up to them? The flip side of Reg A is that you're not registering under the 34 Act, so you're not able to list on a national securities exchange. So you're not going to be NASDAQ or NYSE eligible, and that's why OTC coming in and making this move to provide some market liquidity is so important. I guess, so Scott, Jordan, let me ask you, as a banker, you're looking at all different industries. What's sort of attracting you to this type of market?
Well, the healthcare is my primary background is healthcare and a little bit of real estate. Healthcare is really tough. It's capital intensive, it doesn't yield. And the retail investors don't know what to pick. So from a healthcare perspective, I think it's been tough, it's been challenging. Obviously, the areas that have gotten a lot of traction, SeedInvest, for example, in the technology area, early stage. Real estate, Real Crowd, Real Emogo, Fundrise, etc., has done really well. As an investment banker, though, what we're really interested in is institutional participation, or what we call institutional conversions. We realize that the retail investors will be able to take companies so far and be a bridge to, say, VC private equity capital. We're exploring Reg A Plus, obviously, as we've seen the success of Elio Motors, which I think is more of a retail play, right? Selling stock to your existing shareholders. Can this be repeated? Can it be emulated? And then, of course, Hambrick is active with Aperion Biologics, so from Reg A Plus. So.
Okay, great. And Ryan, so SeedInvest, I guess, started as a Reg D platform. Do you see potential in Reg A? And what types of companies are you seeing coming in your door? And can you explain a little bit about the process of using SeedInvest?
Yeah, sure. So before last summer, when Title IV was enacted, the laws were what they were. So we worked with accredited investors only. Like I said before, we funded about 60 companies through that. I should talk louder, okay. So we funded about 60 companies through Reg D, and Title II of the Jobs Act, the second piece that kicked in, allowed companies to raise capital publicly. So private companies raise capital publicly, and we took advantage of that to allow consumer-facing companies to reach out to their customers and invite them to own a small piece of the company. So that was pretty groundbreaking in September 2013. We had a couple dozen companies that did just that, but until Title IV kicked in, they were restricted to only allowing the customers of those companies that were accredited to actually invest. So when we saw the final rules for Title IV, our thesis was, this will be a big deal for companies that are more established, that already have hundreds of thousands or millions of customers that they can now reach out to and invite to own a small piece of the company. So we've been pursuing that for the last few months, and we've had a handful of companies that have reached out to all their customers and basically invited them to come to SeedInvest and let them know if they're interested in investing. And in the past few months, we've had about 50,000 people who have come to SeedInvest and signed up and expressed $100 million of investment interest in those companies. And now we're allowing people to start investing. So we've had about 1,200 people in the past 2 weeks that have invested through Reg A Plus through the platform.
Are you seeing encroachment by traditional crowdfunding companies? So a lot of people think of crowdfunding, they think of Kickstarter or Indiegogo, which are not investment portals, but they're really donation or pre-retail sites. They obviously have a huge user base and a huge momentum behind them. Are you seeing them looking at this space?
There are two different things. Is selling, giving somebody their name in the credits of a movie or a t-shirt or hat is different than selling securities, very different. And although Kickstarter is fantastic, the average raise on Kickstarter is $7,800. The average raise on SeedInvest last 3 years has been $550,000 with accredited investors, so there's a big difference. So, a good example is we have a company called Virtuix that's in the virtual reality space. They raised $1.1 million on Kickstarter about 3 years ago. After that, they raised $3 million on SeedInvest from accredited investors through 506C. So they advertised that, and they invited their backers to invest as well. And now they just launched 2 weeks ago a Reg A Plus campaign on SeedInvest, and I think they just hit $4 million. So I think it's just different tools for companies along the different stages of their life cycle.
And you charge a fee based on the amount raised?
Yeah, we set up our own broker-dealer a little over a year and a half ago, and we charge companies a commission based on whatever they successfully raise.
So one of the interesting things about the Jobs Act is that it provided, from the old world of registered offering versus private placements, you now have advertised private placements, you have the very small crowdfunding raise, you have intrastate crowdfunding where different states have their own rules for offerings within each state. You have Reg A where you can go up to $50 million to accredited and non-accredited. The one thing it doesn't do is exempt anyone from the broker-dealer rules or the offering rules, and so we have, I think, 4 broker-dealers on the panel. But Mark, I'll start with you. How do you see traditional broker-dealer structure and norms interplaying with this space, and how do you make sense of what's a good offering?
We look at Reg A Plus a little differently. We're looking at it from basically bringing back small cap IPOs. Somebody talked about earlier that in the previous panel that there's not a lot of underwritings that are going on, and I think even in the first few months of this year we're seeing a lot of underwritings that went out to the market but they weren't able to close, and these would be your traditional NASDAQ listings. So when the Reg A Plus came out, we got really excited about it because you pointed out that you have the ability now to market to non-accredited investors across 50 states. What people don't realize is when you're doing a primary offering onto a listed exchange, if you're going out and you have a preconditional letter from NASDAQ and you need to reach a certain minimum, if you're out there working on this and it's a success-based transaction and the issuer is putting a lot of capital forth and there's a lot of lawyers that are involved and bankers and roadshows and all the expenses that go with it, and you come short by $1 million or $2 million, you can't close. It's a big problem. So with Reg A Plus, we're looking at it two ways. We're looking at his ability now for an issuer to go out and be able to reach that same audience utilizing the new social media tools and being able to use the internet. But more importantly, if they fall short in that campaign, they're still able to close and be able to take that capital. And if they do reach the goal that they want, they can easily file an 8A and then uplist immediately onto a higher exchange. But at the same side, if they don't raise enough money, they close it and then they can list OTC. And that's really important to us. And I think what the key, and one of the issues with Title III that I have an issue with, is that there's no liquidity. So yes, after a year, those shares can be resold, but where and how? At least with Reg A Plus, you have an exit strategy where an investor can choose at some point to be able to exit that through the OTC markets and be able to liquidate the position. So we think Reg A Plus is the greatest part of the Jobs Act. It's going to bring back small cap IPOs, and it's going to allow individual investors now to participate in an institutional world and allow issuers to be able to raise the capital that they need.
So just following up on that, is it the case that OTC will accept a lesser category in terms of proven financials and other criteria, or maybe Carl can answer? You're obviously not open for everyone, right? There's a vetting process.
Yeah, I mean, there's a vet. Well, we've got our pick market, which is kind of the Star Wars bar of markets, and it's fine. Like, there should be a place where risky securities, where you can get the best price based on supply demand. You watch, Storage Wars. As peering in, they can price that. But that's a market. That's a real risky market. It's scary for people. Most people don't want to walk into a Star Wars bar. Lots of sophisticated professionals do. But we created what is our premium markets, which are OTCQX. You can't be a penny stock. You need to meet financial standards, which were based on the State Uniform Securities Act, which is not really uniform, but it's a good baseline. And you need baseline corporate governance, which was what NASDAQ had in the 90s before the governance became too costly and painful. And then we've got OTCQB as a venture market. And a venture market is giving companies a chance for success. And by definition, you've got companies that have not yet fully succeeded. And you'll have companies that don't succeed. But it gives entrepreneurs a shot. And those places are, I see it, there's always a very NASDAQ-centric world. Because in the space, if you're a lawyer, you make a lot more money if someone lists on NASDAQ. But just like the integrators who used to sell SAP, eventually Salesforce came out with a lighter, faster, more efficient that helped people get the job done. And that's what our markets are. And eventually the SAP integrator said, hey, we can have a lot more customers, we can solve their problems much more quickly, and if they grow big enough that they need this heavyweight enterprise solution, that's great, but they don't need it when they're too small and it might kill them. And and that's how I'd say our markets are. So we try to be very agnostic. What's your disclosure date? You want to do Reg A? That's great. You did a Reg D private placement, but you've got audited financials by a PCOB and you're making your disclosure for alternative reporting standard. That's fantastic. If you're SEC reporting, that's great. If you're a community bank reporting to your federal regulator, that's fabulous too. If you're listed on the Toronto Stock Exchange or the TSX Venture, you can use your disclosure there. Investors just want the information on their screen, and our job is to make sure that it's current, consistent, and compliant with securities laws.
Great. So if I'm a small company and I'm looking at venture option versus raising capital, I guess, so Scott, Jordan, I'll ask you, what's my first phone call? Do I call you? Do I call Mark? Do I go to Sand Hill Road and try my luck there for a week? What's the conventional path?
Well, it's all depending on the market sector, financing stage of development, the preferences of the management team as far as ownership, and control, for example. All those factors play into whether a company wants to, and let's face it, venture capital, if we take a look at the size of the companies, the earlier stage companies still are not, there's really not a focus there. In the healthcare side, the venture firms are down, I think 48% from funding early stage biotech companies. So those companies, what is the alternative for companies that either do not want to access venture capital due to controlled issues, or say they're not in the hotbeds of Boston and San Francisco in the healthcare space, and they're in the midsection like in Chicago? What are the options for those companies to access capital? And there's pros and cons. But I'm with Mark in a big respect. I think Reg A Plus, what's really interesting about it, is the surrogate for the IPOs, early stage IPOs. We are building a portal in Singapore with the Singapore Exchange, which is similar to the NASDAQ private markets, where it's called CapRidge, and CapRidge is going to be agnostic to industry and try to be a global platform to do pre-IPO financing, to take companies from the private markets and graduate them into the public markets. And in this case, it's Singapore Stock Exchange. And Singapore Exchange has 28% foreign IPOs, and their target is 100 to 300. I think that, coupled with the Reg A Plus and what Mark's doing, I think is the real upside for a lot of companies that are later stage are those avenues. On the earlier stage, obviously some of the groups like AngelList, SeedInvest, I think Funders Club, Circle Up, for example, I think are real viable options. So,
have you, I guess Ryan, have you found that companies that go on SeedInvest get the cold shoulder when they do later round and they try and access venture?
No, I mean, in fact, the majority of companies we've funded, we've actually got investors in at the same terms alongside venture capitalists or angel groups. So even if you're raising capital at the early stages from a VC or micro VC or an angel group, it's a club deal. You have somebody investing, but then you might spend 6 to 9 months sort of running around trying to find individual angels to fill up a round. And the last thing you want entrepreneurs to be doing is spending all their time fundraising instead of building their business, but that's what happens. So our value prop is great. You get a check from a VC, and then come to SeedInvest, and we'll fill out the rest of the round. We'll do it quickly and hopefully get some value-add people into the round as well. So I think when we all sort of started up around the Jobs Act, I guess 4 years ago now, which is scary, there was certainly a perception that that was going to be the case, and that's totally changed. I think any sort of VC you talk to now is very open to people using certain platforms to help the companies out.
I actually did trips to Sand Hill Road about every 6 months over the last 4 years, and at the beginning, I think someone actually said to me, not only do we not understand what you're doing, we don't know why anyone would do it. And I think they've warmed to it. Then it was, oh, that's something very curious that we think might affect us and we want to pay attention to it. And now it's who should we get into and which of the platforms are going to win the horse race that's going on to be kind of the top platform in the space. And I think all of us that were around at the beginning made choices about what's our approach going to be. Is our approach going to be primarily platform and retail? Is it going to be primarily institutional leverage with the platform? Or like OfferBoard is it going to be a hybrid where we have both kind of institutional brokers that are working on institutional side cap raises and a retail platform?
We have time for questions if anyone has any questions. Otherwise, I'll press forward. Yes?
It might be a loaded question for such a big group, but because everybody obviously coming into something, it's a whole new space that combines a bunch of sectors, from tech to finance to healthcare. What are the sort of formative experiences for each of you? Or what are the sort of combinations of experiences that have led you, put you in a position, you think, to take advantage of this, or even realize what's going on and want to jump on?
So, the question was, what are the formative experiences that the panelists have had that gotten
experientially, what's important?
So I'm going to tell you why we went that way. So a lot of people question, why are we coming into a retail world when it's easy to make 5 phone calls and raise $50 million, to make 100 phone calls 1,000 emails, hundreds of thousands of emails to make a fraction of that. And it really comes down to liquidity. The market itself has taken a big hit. After 2010, everybody thought that we saw a downturn in the pipe market and the secondaries and the follow-ons, and everybody started going now to a registered area where they were no longer doing traditional pipes, but they were doing more registered deals. And to do a registered deal, you need liquidity, and the terms started changing, and it started not to become very attractive to the issuers. There's a new breed of investors that have come up that have made a lot of money doing this, but there hasn't been an alternative available to the retail investor to get quality product at an institutional structure. And I'm finding, actually, one of the things I wanted to say about this is Reg A Plus, again, we're looking at it as a way to bring back a small cap IPO. But some of the recent successes have, I think, skewed the market. I've had a lot of issuers come through and see that certain companies are getting high valuations, and they're closing a lot of money from a lot of investors, and they think it's that easy to do. And then they go out and they say, all right, well, I want to do an institutional round. You bring in 15 million of institutional money, I'll bring in 5 million of retail money. And there's a disconnect because institutions are willing to base their investment on fundamentals in the future, where a retail investor is going to invest on the dream. So we're finding now that there's a problem, like every entrepreneur, where there's a disconnect between basically what they feel the valuation should be to what a deal can really get sold. So I think there's going to be a disappointment in the market. And what we're trying to do is bridge that, where we're going to be looking to try to explain to an issuer if they're going after an institutional model, very similar to what you're saying with SeedInvest, where you have a lead institution, you have a lead anchor investor, and then you round it out with retail. I think that's the way it's going to be successful.
I have a little bit of a different perspective. So, basically, I was an investor before, so I started at Lehman, and then I was in a private equity firm here in New York, and went back to business school to do something more entrepreneurial, and had a ton of just entrepreneurs around me that were raising capital for their startups, and it was a disaster. I mean, literally, people driving around in cars trying to find out who was wealthy and pitch them, and such a broken process. It just hasn't changed in 100 years, and it's because basically these laws were antiquated and you couldn't use the internet at all to sort of streamline things. And so, you look at the public markets, and I think Cromwell alluded to this a little bit with Amazon, but public markets, sort of in the late 80s, if you wanted to buy a share of stock, you had to pick up the phone and call your broker, and then basically E-Trade and Charles Schwab and folks came along, and more transparency, lower costs, better access, and so you had like 5% of the country buying public stocks. All of a sudden, with the internet, it jumped to like 20% pretty quickly, and because of the Jobs Act, and its simplicity, things are finally moving online. So the internet's disrupted almost every industry. Now it's coming for the private market. So, this theme, we're really early in the space, but we're betting that the private capital markets are going to look a lot more like the public capital markets 5 to 10 years down the road.
My background is I'm a securities regulator for 20 years, former prosecutor at the New York Attorney General's Office of the Securities Bureau, enforcement attorney at the New York Stock Exchange, enforcement attorney at FINRA. I left FINRA last year. What attracted me to the space is, you see people now, when you raise money under Title II or Title IV, you don't need to use a market intermediary. An issuer can do that on their own. But what you're doing is you're having people raise capital who don't know anything about kind of the securities laws. So just a caveat, remember, everything with respect to the securities laws is you have to disclose all material facts, and if you don't, you could get in big trouble for it. So what attracted me to the space is, in addition to needing, your securities lawyer to help you, you also need platforms or technology companies that also can help you from a compliance perspective. The company that I'm general counsel for, FundAmerica, they have something that's called the Invest Now button. You could cut and paste it to any internet where you place your offering details, which enables somebody to go on a website, hit a button, enter into a FundAmerica, which is a broker-dealer, registered broker-dealer, FINRA member, back office, and enter their investment immediately. So we're talking about the ability of people to, on their cell phone, iPhone, I'm sorry, hit a couple of buttons, enter an investment. We talked a little bit earlier, Cromwell referred to kind of digging where you're swiping left or right, whichever way you're inclined to do so. But soon, you're going to have the ability to do things like that over with respect to investments. So the key thing is when you do it, you have to make sure that you do it in a compliant way. And some of that requires escrow. You're under both federal securities laws. You have to comply with state securities laws, which requires a registered agent to be involved with your sale unless you fall under an exemption. So there's companies like FundAmerica that are out there and available to help you from a compliance perspective to raise your capital.
Scott, I have to ask you, so you came from virtually every regulated Rocket Mortgage, we're seeing mobile, we're seeing sort of push button get mortgage on your phone. I'm sensing that regulators might start to feel like the tech is getting a little bit over its skis in terms of keeping up with the regulatory compliance element. Are you seeing that from regulators, either formally or informally, in terms of this kind of latent discomfort with the way things are evolving? There was a joke that the Rocket Mortgage thing, you could, to crash the economy, swipe right, and you can do that on your phone now. So, what's your view on that?
In my experience, I've seen, remember the industry's always way ahead of the regulators. The regulators are always trying to catch up, and that causes a lot of agita and concern by them. They don't understand exactly how it's all working. But what I understand, or what I believe, is that a lot of the regulators are trying to kind of get up to speed and be more flexible in their kind of approach. So I've had good experiences having discussions. On Elio Motors, for example, I was involved in doing the first 5110 filing with FINRA under the new Reg A Plus. That was quite an experience. They didn't know quite what it was when they saw it, because Reg A in the past, it didn't have something that's called preemption, which is probably the most important thing about the Jobs Act, if you've ever tried to do state securities filings before. But we had a very good experience. In my experience, they've been very professional and open-minded to seeing different ways to doing things.
Yeah. We'll go to another question. There's a famous story that before there was preemption, the state securities regulators could decide whether or not to approve IPO sales in their states, and the state of Massachusetts actually blocked the sale of the Apple IPO in Massachusetts as a way of protecting its citizens. And then they were the ones that sued to undo the preemption under Reg A. You had a question in the back.
Yeah, I did. I guess with Scott and Chris. Chris, I sit on the board of a company raising money for OfferBoard, by the way. What would you say are the percentages of success, failure compared to the old way of doing it? Because we're all sitting here and we're all excited by the whole new ways of doing things, but there's still a pretty high failure rate out there. And do you vet the companies that come in? Meaning, is it an open platform? You pay a monthly fee, there's a bunch of them out there? Or is there some standard that you guys are setting?
We're not an open platform. OfferBoard does a significant amount of vetting before we do a capital raise for a company. And that's everything from kind of document diligence to making sure that there's a professional and someone with a license that is willing to take on the raise and execute the raise. And so I think there is a wide variety of platforms, from the completely unregulated that are just matching and doing no vetting and are effectively posting sites, to those that own their own broker-dealers, and you've got several of us up here who are doing kind of full FINRA-compliant broker-dealer diligence on all the offerings on their site.
And does that improve the success rate then?
Yes, I think by taking fewer, I think if you look at the numbers of the success rate of capital raises on just posting sites versus sites that are doing that, I think there's a significantly higher success rate on sites that have done vetting and are being selective about which offerings are allowed on the platform.
We've accepted 1% of companies historically, and over 75% of them have been successful over the last 3 years.
And ours keeps going down. Our percentage keeps going down, and I think Ryan. The last time I was on the panel with Ryan, it was 3. So I think all of our numbers continue to go down as the number of applicants goes up, and the more people hear about the availability of raising capital online. So,
Mark, is there do I understand that if I go on Reg A or I go to the OTC site, I actually can execute a trade, and there's a fairly narrow bid-ask range I belong also to Fantex, which is the athlete IPOs, and you see very wide bid-ask spreads on that site. Yes, it's a FINRA-regulated broker-dealer. Yes, they're real investments, but somebody's offering at 16, somebody wants to buy at 10, and the last trade was 5 weeks ago. Is that is your experience that this is going to be a much more active space that more resembles a NASDAQ?
Well, I think it is. But I think there's like any new issue, any new company that comes out. I think it's also a function of supply and demand. And right now, on certain issues that are out there, there's not a lot of great demand, and there's not a lot of supply available. As that supply starts to come in, fundamentals are going to have to start to occur in order to keep that market orderly. But it's important that when a company comes public and starts to trade, that they have shareholder communication, that they act in a responsible manner. They're taking outside capital, and that means having a robust, I think, IR campaign to keep your shareholders apprised of the developments. Our requirement is, and it's not a requirement to be listed on the OTC, but we're requiring our clients to do their Ks and Qs and become a 34 Act company and continue to trade OTC, because I think selective disclosure twice a year is not adequate. I think you need to see disclosure quarterly and yearly.
Well, just QX, we require the Reg A's to do the additional quarterly. The downside, if you do a Reg A plus, if you immediately file to be SEC reporting, you don't get to do a Reg A plus next year.
Correct.
So I would, is that piece is you're taking away a piece of optionality.
Unless something changes.
Yeah.
True. Good point. So I think it's important. So to get liquidity, you need to have disclosure. To get liquidity, you need to be active and doing what any other public company does. Go out and tell the shareholders and tell everybody what you're doing. I think investors need to be cautious to look at the disclosure and look at the financial statements and not get caught up in the hype, and look at how these companies are going to develop. I think there are a lot of companies that I see on a lot of my competitor sites that are great deals, and they're going to be great opportunities for investors to participate in. And once they start to trade, if they trade, I think it will be a good opportunity for those that missed the Reg A offering now to get into the aftermarket.
You had a question?
Yeah, just first of all, from Senate Hill Partners, a fintech venture capital investment bank in New York. And one of the questions that we have in terms of what types of offerings you suggest to our portfolio companies is, with the new requirements, should you do a Reg D or a Reg A? And I know, obviously less than 50 million for Reg A plus, but where really is that sweet spot where you would say, okay, if it's over 25, you should do Reg A plus. If it's under that, you should do a Reg D. Kind of where is that range, and what are the pros and cons of doing one versus the other, besides for the typical, private versus public securities?
Happy to take it. We're advising companies. It depends on the company, but we would say if you're raising less than $3 to $5 million, you should just do Reg D, because the costs and complexity of getting SEC qualification is just probably not worth it. Might be different, I guess, if you're ready of audits, but if you don't, that also adds to the cost. So that's how we've typically been advising companies. For us, I mean, whether you should do Reg A depends on the company. Like I said before, we're typically right now focused on companies that are consumer facing, that can help sort of reach out to their customers. But I think that a small piece of the company that doesn't sort of fit all companies. Obviously, if somebody spoke about Title III, that will be for companies raising their first $500K to $1 million. So I think it depends on the company, but that's what we're guiding people at.
I would add to what Ryan said, that for us it's more about who you're raising money from than the amount of money. Most of the raises on OfferBoard are over $2 million, so we've already kind of broached some kind of threshold. And it's whether you have a ready-made audience of unaccredited investors to sell securities to, because for most people who are coming to us asking to do a Reg D ends up being more appropriate because of the kind of investor they're looking for, and that they don't have available customer base. They're not a consumer-facing product brand that already has a base of customers that would want to invest in it.
And on the high end of that, if you're actually going to get to 50, there's a liquidity disconnect, I would think, in your valuation between doing a real NASDAQ deal where you have a slightly more liquid market versus a Reg A. Is that right?
I feel like I don't see why any company in a few years, once everyone learns about Reg A plus, why you would raise a sub $50 million IPO without doing Reg I'm sure there are reasons, but I think it's education, to be honest. I mean, it takes so much less time. You have state preemption, the costs are way lower. I don't know why people wouldn't just use Reg A Plus going forward.
Can I touch upon that point?
Yeah.
Because, I mean, we're talking about the industry. I work with NASDAQ. I work with entrepreneurs. So, and I understand the retail component, the easy access through crowdfunding if you want to pick up that retail base. But what's remarkable is Uber started on AngelList and now has some whatever the $1 billion valuation is. So somehow they bridge the gap. But I almost see there is a certain space in the market for companies, and I know one, I'm working with one right now, that literally wants to ramp super fast and give the big gorilla a run for its money. So they're moving away right now from crowdfunding because they're going for the unicorn status, so to get the funding to grow at that pace and that required pace. It's almost as if by default they should be talking to me.
Yeah. Well, remember also that these are non-exclusive safe harbors, so you can do Reg A and Reg D. And doing one does not preclude you from.
How much are they raising?
We'll talk.
No, I didn't mean it like that. But like, we had a company 6 months ago that raised $10 million. We did 1.8 of it on our platform, and now they're closing 30 million, and we're doing 4 of it. So I mean, they're pretty fast growing companies that are raising a lot of capital.
But what I want to understand is, I mean, if you raise 50 million through Reg A plus, you're locked out for another year to come back to the market? Is that
Under Reg A, but not under the private place, the other accredited investor private placements.
Okay, got it. Thanks.
So you had a question, David Farmer.
Yeah. These platforms and Reg A, etc., are they purely for American domiciled companies, or are they for, can you be registered anywhere?
Reg A is, US based or Canadian based, right?
Yep. Reg A is US and Canada. Title III is just US, and Reg D is anywhere.
So credit investors anywhere. Reg A, be based there.
Reg D would actually be Reg S.
You can have international investors with the companies would have to sort of be based there.
One of the interesting things about Reg A is that it's really the first US-Canadian cooperative cross-jurisdictional statute. You had a way of listing both in Canada and the US under something called the MJDS, which is the multi-jurisdictional disclosure rules, which basically said that if you do a filing in the US and one in Canada, and you do the disclosure that your home country requires, then that would be sufficient. But you still needed joint, usually it was Ontario, Ontario Exchange approval, Securities Commission approval, and US. Reg D, you are automatically qualified through whichever provinces in Canada you choose to list under Reg A. So that's an interesting element there. Yes?
So, Board Director Shell for Vintage, for a division of Pierre Wire. Just wondering what happens next month. Are we going to be muddying the waters? Because we've talked about Elio. If you look at Fundrise, companies that have done crowd-funded raises of Regulation A securities, but these are not crowdfunding securities, right? So maybe it was just unfortunately named in the Jobs Act that there's regulation crowdfunding. So next month, now we have real crowdfunding, which is very different from Regulation A+. And we're talking about going to non-accredited investors. I participated in a call today where we're talking about Elio, and there are now shareholders in Elio who are opening up brokerage accounts for the first time and have essentially no idea what they're doing, right? So what are you guys looking at in terms of how do you distinguish starting next month?
Yes,
a funding portal.
Right, so what we was referring to next month, what he's talking about is in May, the last piece of the Jobs Act comes into effect, which is Title III, national crowdfunding. You can raise up to $1 million from both accredited and non-accredited investors. There are strict investor caps based on whether you have both net worth and income above and below $100,000. It also ties your investor caps across all of your Title III deals. So it's really the only thing that you actually can be maxed out on one deal and not be able to invest in another one. Full IPO prospectus strict liability. You must use a broker-dealer or a funding portal. You must file a disclosure document with the SEC. And essentially, it's a much more difficult process than, say, a Reg D capital raise, where you can raise an unlimited amount of money from an unlimited number of accredited investors, technically speaking, without a disclosure document, without showing your face to the SEC in advance, so, and with a lower liability standard. So a lot of people are thinking, well, you know, is this sort of designed as the capital raise of last resort, where if I can't get a Reg D done, I can't get traditional VC money, I can't get a Reg A deal off the ground, maybe I'll try this Title III, and you take a risky asset class to begin with, and you open up the investor market to our most risk-averse investors, or ones who should be, which is the retail marketplace. And so that's why I think the SEC has done some foot dragging in terms of getting Title III out the door. But I'm wondering if you guys, obviously the dollar values are so low in that space that it doesn't make a lot of sense for,
well, I think they got it
for any of us to be involved.
I think the SEC was perfect by making us be broker-dealers to do it, because I can tell you as a broker-dealer, there's no way we would go into that world. You're talking about unsophisticated investors, unsophisticated issuers, unsophisticated structure with no chance of liquidity.
And higher
That's
liability.
a customer complaint waiting to happen.
And strict liability.
The perfect thing for, in the regulator perspective, the individuals that the regulators want to protect.
I would, I'll give you a different opinion. So when Title III goes live, there'll be a ton of noise and a ton of confusion, to your point. I think what's really important, though, is that regardless, to us, I mean, regardless of Title III or Regulation A, you've got, you know, a lot of non-accredited people who are investing in private companies for the very first time. And I don't care what they invest through, what regulation. What is important is education. So, you know, people need to know that don't put more than 5% or 10% of your overall portfolio into this stuff, regardless of what regulation it is. Make sure you're diversified, because most of these companies are going to fail. So build a portfolio or don't invest at all. And lastly, unless you know that they are going to, you know, uplist on the OTC, assume that there is no liquidity and that you're going to be locked up for 5 to 7 years. And regardless of what regulation people go through, I think hopefully that message will get out to the people who are doing this for the first time.